For the viewers, I would be looking for something that just comes out of left field. If you remember them announcing Lehman Brothers, nobody knew anything about it. It's just that, here's the Secretary of the Treasury and the Chairman of the Federal Reserve, and they're on TV on a Monday morning announcing the biggest failure in history. And if something happens, it'll either have to do, politically or economically, like Lehman Brothers, but it'll be coming out of left field. And so very suddenly, the rush to safe haven assets will change from just a trickle to a flood.
Macroeconomist and precious metals legend Mike Maloney is known for his in-depth analyses of economic cycles and his expertise in gold and silver markets. In his analysis, Mike warns that the current economic imbalance could trigger an unexpected crisis, similar to the sudden collapse of Lehman Brothers. He believes this crisis may occur between now and Inauguration Day, driving a surge towards safe haven assets like gold. The longer-term positive aspect of gold as a hedge and safe haven asset play to counter a potential wider U.S. federal budget deficit caused by Trump's generous corporate tax cuts policy, in turn a catalyst for an erosion of confidence in the demand for U.S. Treasuries, has now taken a back seat. Fundamentally, Mike notes that gold and silver, after reaching all-time highs, were due for a rest and retracement. Despite this, Mike remains optimistic, seeing a bright future for gold and silver. According to Heraeus Precious Metals, the price of gold will continue to rise in the coming year, 2024, and reach new records. The price of silver will also rise, but not as well as gold. Reflecting on the Federal Reserve's actions since 2008, Mike warns that the ongoing economic imbalances are setting the stage for a larger crash. He predicts an unprecedented inflationary event driven by the COVID response and mounting national debt. Inflation had barely registered on America's radar in recent years, but prices spiked in the pandemic, and the annual inflation rate reached a 40-year high of 9.1% in mid-2022. The Fed stepped in, raising interest rates dramatically in 2022 and 2023 to cool the economy. Inflation retreated below 4% in mid-2023, but it still hovers above the 2% target set by federal regulators. During the stagflation of the 1970s, gold prices rose at an average annualized rate of over 30% over the course of the decade. Now we present the clips of Mike Maloney's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
One of the things that I want to mention is that gold and silver were coming off of all-time highs, and it was sort of time for them to take a rest and do a retracement. They had just been, I had talked quite a while ago about the pan and handle or cup and handle that had developed. And in the handle, there was a inverse head and shoulders pattern, a triple top that we were about to violate. And I said there would be a slingshot move, and that's exactly what we got. So it was time for them to take a rest and a pullback, but I see a very bright future coming up for gold and silver, and we'll talk about that later. Well, we did a video several weeks ago, gold, farmland, and Bitcoin. And I think that those are, cryptos and precious metals are part of the places to be. But I absolutely believe that the economy is too warped and too out of balance. And those pressures that build up when it's out of balance, that's like an energy potential. And that we are headed for some sort of crisis. I thought it would happen before the election, but, is it going to happen between now and Inauguration Day? There are things that are suggesting yes, but I would, for the viewers, I would be looking for something that just comes out of left field. If you remember them announcing Lehman Brothers, nobody knew anything about it. It's just that, here's the Secretary of the Treasury and the Chairman of the Federal Reserve, and they're on TV on a Monday morning announcing the biggest failure in history. And something, if something happens, it'll either have to do, politically or economically, like Lehman Brothers, but it'll be coming out of left field. And so very suddenly, the rush to safe haven assets will change from just a trickle to a flood. Most of this century has been an emergency. It's one emergency after another emergency after another emergency. Federal Reserve's reaction to one emergency after another. And I do believe that that is going to continue. I believe that the things that Ben Bernanke set in motion with QE and interest rates and the way, because the way that the Federal Reserve manipulates the economy is very different prior to 2008 and after 2008. Everything changed once Ben Bernanke. So I believe Bernanomics is storing more energy to cause an even greater crash than was stored before 2008 with the warping, the real estate bubble that we had and mortgage-backed securities and everything else. We've got a lot that is wrong with the economy right now. And it's interesting, every time something breaks, all of these people that caused the warping say, the free market isn't working, we've got to do something. And they manipulate it and they set us up for the next big crash. And they have done that. The reaction to COVID, you talked about currency creation. Well, each time they sort of have to double down on it. Look at Powell did as much in the response to COVID as Ben Bernanke did over a period of years in QE1, QE2, and QE3. It was the same amount of the scale of currency creation compressed into just a few months. And so with the deficits that we're currently running, the size of the national debt, everything else, this is going to, the next great inflation of base currency is going to be on a scale that matches the size of the national debt and everything. So it's going to be something we've never seen before, just like the response to COVID.
Regarding the Fed's strategy, their repeated approach of using low interest rates and currency creation to stimulate the economy, which results in bubbles that eventually burst. This pattern of intervention, often creating booms in stocks or real estate, leads to greater economic distortion. The gold price tracks money supply growth. For that reason, the last 50 years have seen exponential returns in gold. Fortunately for gold investors, these parabolic money supply increases are far from over. Concurrently, Mike particularly suggests that a sustained bull market in precious metals is expected to continue with this ongoing cycle. Over the past 5 years, gold has rallied by more than 80%, comfortably outpacing the returns for other low-risk investment vehicles like bonds and high-yield savings accounts. Precious metals can rise with stock market rallies, but their lack of correlation also enables gold rallies during market corrections. Let's get back to the interview.
Absolutely. We know the Fed's playbook. I do believe that there is something else around the corner, and the longer it takes to happen, the worse it will be, because the greater the warping of the economy and the pressures that are building up. And so the Fed's playbook is drop interest rates to zero, create a whole bunch of currency. The currency then creates inflation, and because the rates are being artificially held too low, to try and pump the economy back into bubbles, because that's what they've done for this entire century. All of those negative rates are an attempt to pump bubbles. It started with the NASDAQ crashing in the year 2000, and they do this negative real rate causes bubbles to inflate, and then the bubbles pop, and so they double down on the negative real rates. You can see that after 2010, the residual from what was happening with the global financial crisis, pumping to get the world economy going again, caused that first big, and then with COVID, the negative real rates there are just insane. And so we know the Fed's playbook. They've been doing it now for more than 20 years. And as soon as a bubble starts to pop, they're going to try to reflate that bubble. And it just keeps the economy warped and causes these booms and crashes to become much worse and more distorted. The booms have been limited to the places where currency creation goes to first. They create a boom in the stock market, or a boom in real estate. With low interest rates, it's a boom in real estate. With currency creation, it's a boom in the stock market. It's wherever that currency goes first. If the banks are loaning the currency into existence, that's usually for real estate and for margin loans. If it's the Federal Reserve creating currency through QE, that's just going directly into the stock markets. And so we know the playbook. If anything happens in the economy, this thing will turn red again. That's my analysis. So it's going to look very much like the 70s, where it's red, gray, red, gray, red, gray, but mostly red. But even more so than the 70s, like it already does look. And until they get things really under control, and they're out of control, this will persist, meaning the bull market in precious metals will persist.
Parabolic growth in global debt levels and the money supply will continue to push investors toward the world's oldest and most trusted currency. The massive increase in the price of gold reflects the devaluation of everything else. Gold's historical resilience, with its capacity to rise independently of other markets, bolsters Maloney's conviction that a sustained bull market in gold and silver lies ahead. Could gold and silver become essential safeguards against future financial crises? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.